since you have understood what a covered call is, people asked me, they were like, how do I cough up the money to buy 100 stocks of Tesla or Apple to be able to sell a covered call? But hey, Plutus is all about making money for everyone. So we're gonna give you a hack to the covered call strategy, but with a significantly less money up front. We have something that's literally called a poor man's covered call. And I use this strategy all the time because it uses less of your capital and still harnesses the power of a covered call option strategy. Before we go into what a poor man's covered call is, please check out our video on what a covered call is to help you understand some of the concepts that we'll be going through. So let's dive right into a poor man's covered call. So let's say you are bullish, or you're hoping that Apple will go up in the next 30 to 60 days. However, you don't have $14,000 to buy 100 shares of Apple at $140 each. So what you do is you buy what's called a leap. So a leap is an option or a call option contract that is far away. So 2 years or a year out. So let's say for Apple, you pick up a leap call option that expires in January 2023. So people vary in terms of what kind of deep in the money leap that they buy. Some people like a delta of 0.7, they are more risk tolerant. Other people like a delta of 0.9. So as you recall, delta essentially means the change in price of the option contract premium with $1 change in the underlying asset. So if you have a delta of 0.9 on a call option, that means that the call option premium will mimic the underlying asset very closely, because there's a 90% chance of this call option ending in the money. Without getting too distracted and making it too complicated, you have to pick an in the money leap option of delta ranging from 0.7 to 0.9. Now that will also depend on the premium or money that you have available. So let's say for this example, Apple is trading at $140. But you'll buy a leap of 120. It's an in the money call option. It's already in the money. You're already making $20 on your shares if you were to exercise that option and sell it. So 120 leap expiring in January 2023 when the stock is trading 140 with a delta of 0.8. You are going to pay $10 for this hypothetical leap option. So now you have control of 100 shares of Apple at $120 each. But the key here is that if you bought 100 shares outright, you would have had to put down $14,000. This leap will cost you only $1,000. Or let's be more realistic, this will cost you $2,000, but you don't have to have $14,000 up front to have a covered call. So keep that in mind. So you have paid $2,000 to buy this leap option at 120. Now what you do is, how you make money off it, like selling a covered call, you will sell an out of the money call option with a 30-day expiry, or let's say some people do weeklies. So a weekly week out of the money call option with a delta of 0.3 or less, because you only want a 30% chance of this short leg ending up in the money. So for this sell portion, you will make a premium. So let's say in this case, you will make a premium of $200. But what you have done is that with that leap, you have only had to put in a capital of $2,000 instead of $14,000. So what you can keep on doing is you can keep on repeating this. So your leap stays in there, providing you that covered option, that safety net, and you do weekly or monthly out of the money, short dated call options. You're selling them and collecting the premium while having that security net. This is more of a complicated strategy, and as we go along, we'll use an example to describe this for you and lay it out for you. But I want to really hammer this concept because a lot of people get really confused. There are other there's other little tidbits that you always have to keep in mind with a spread. This is a spread that you have to keep in mind, and we will go over when to close a poor man's covered call, when to manage it. But on a global scale, this is how a poor man's covered call works, where you can make money without having a lot of capital upfront. Just a final thought on poor man covered call. Let's look at a practical aspect that you always have to keep in mind. So when you do a poor man's covered call, there is a net debit. You are paying something more than what you're getting in the short term. So this net debit should be less than 75% of the width of your spread. So let's talk more about what that means. So let's say you have a stock that's trading at $100. You have bought a leap of $90 and you have paid $15 for it. So that's your long-term protection. And then in the near-term cycle, you are selling an out-of-the-money 110 call option because the stock's trading at 100. And for this, you make $5. So your net debit that you have paid $15 for the leap, you have made $5 for the out-of-the-money call that you have sold. So your net debit is $10 for a 20-point wide spread. So your spread is the difference between your strike expiry. So 110 and 90 for a 20-point spread. So again, please keep that in mind, that your net debit should always be less than 75% of the width of the strike prices, because that's how you can make money and not be stuck with a non-profitable poor man's covered call. And as I alluded earlier, we'll go into deeper details about this poor man covered call, but staying true to our channel, we just want to keep it simple so that you understand this and use this to your advantage. It's time for ticker of the week. We're talking about NVDA today, which is a graphic card maker and a chip maker. So as you are probably aware that there is a global chip shortage, possibly denting the profits of major chip makers. However, I feel like that the sell-off is more pronounced than the fundamentals. So if you look at NVDA, the stock is trading about $560 at the end of the day today, down a fair bit from its 52-week high of $648. Again, in my mind, I don't have a position in NVIDIA, but I've been keeping a close eye on it, is that this sell-off is over-exaggerated, as we saw with Visa in the case where that's my profitable trade. So I think NVIDIA has a good buy point. It will be in my watch list to see what's going on, because NVIDIA has come up with its new line of graphic cards, the RTX 30s, as well as revamping its laptop line. So keep an eye out on NVIDIA. I see in the short term that this is a good trade to make, where we can make some money, because even if it hits $600 and not even reaches its 52-week high of $648 or close to it, it's still a profitable trade. And talking about option strategies and a poor man covered call, this is a stock that could be very amenable to that, because if you had to own 100 shares outright of NVIDIA, that would cost you $56,000 according to the closing price today. But with a poor man's covered call, you can do that with much less capital, staying true to the theme of this video. Please stay tuned, subscribe, like, and comment so we can keep on making good content for you.